Hi, Travis Daggett with Cornerstone Properties, talking today about purchasing properties, or if you're a homeowner, selling a property subject to the existing financing, or similarly, having someone else assume your loan. So in general, loans or mortgages are assumable, meaning somebody else can assume them, take them on, become responsible for them, or they're non-assumable. In the case, the only difference really is just whether someone's name goes onto the mortgage or not, but everything else is going to be the same. So the general idea is that there is a loan in place on the property, a mortgage, that has favorable terms. That would be primarily a low interest rate. So let's say that right now loans are 4% interest. Now historically the median rate, or the average rate over time, has been 8%. So it's been pretty low for quite a while, historically below 8%. But let's say it's 4%. Now if you have a 4% loan on your property and somebody is going to purchase the property, and particularly if it's somebody like us, an investor, and we're going to purchase the property to renovate it and then either rent it out or sell it to a homeowner. If we're going to go get a loan on a property, then we're going to be buying or getting a loan not as owner occupants, but really as investors, as non-owner occupants. So because of that, most of the time, right off the bat, our interest rate is going to be about a point higher, or 1% higher. So instead of 4%, we're going to have to get a 5% loan. In addition to that, there's a limit on how many loans as an investor you can get, or how many mortgages you can have. So we reach that pretty quickly because we buy a lot of homes. So that restricts us from getting a loan on a property too. Now we do buy our properties for cash, of course, but we like to then at some point get a mortgage with a bank on them to free up our money again. So the advantage for you as a homeowner to sell your property with having someone assume the mortgage, or having them purchase it subject to the existing mortgage, meaning it just stays in place, is most of the time the buyer is able to pay more for the property because they don't have the cost of funds. They don't have to go out and get a loan. And there's all the closing costs associated with the loan. And that could be several $1,000s. So in that case, often the purchaser can pass that on to you as an increased purchase price. So for most people, this is something they haven't done before. It's something they may have heard of, but they don't really quite understand. And it's something, unfortunately, a lot of real estate agents and mortgage brokers are unfamiliar with as well. So initial knee-jerk reaction may be, you can't do that, or that's illegal. However, we've done it dozens, probably hundreds of times over the course of 35 years. And we've never failed to pay somebody's mortgage or make their payment on all the properties that we purchased subject to the existing mortgage, or we've assumed the mortgage. So, of course, what is the risk? That's always the big question if people are uncomfortable with it. Well, the risk is whoever the purchaser is the buyer won't pay the mortgage. If your name is still on the mortgage, well, now you're responsible. However, again, first of all, we've never done that, and we also personally guarantee it. But if you think about it, what would happen if somebody didn't pay the mortgage? So first of all, we normally pay a significant down payment. So let's just say we're purchasing a property for $300,000, and it has a $200,000 mortgage on it that we're going to leave in place, and we put a $50,000 down payment. Well, I guess in this case, that'd be if we're buying it for $300,000, it'd be a $100,000 down payment essentially. So you'd have $100,000 cash in your pocket. Not only that, then we do renovations. So let's say we did $50,000 in renovations to it. And at some point then we don't make payments. So you get the house back, and you may not want the house back, but now what do you have? You have $100,000 in cash, and you have $50,000 in improvements in the house. So that's not really that bad. Again, we've never done it. The chances of it happening are very small. But we can also do other things too if people prefer. We can put the money for the mortgage payments in escrow. So a neutral third party is holding them at the title company. We can even put the funds for the renovations in there and have the seller, the homeowner, approve the release of the funds for the renovations as we go. There's all different kinds of ways we can do it, but in the end, it's really a win-win because the homeowner or the seller can get more money for the sale, and the purchaser or the buyer can save some money on cost of funds and not have to tie up all of the purchase price in addition to the renovation, but just the renovation and any difference between the mortgage and the agreed purchase price. So hope that makes sense. If you have a property that you're interested in selling and you'd like to sell it quickly for cash, give us a call. If you have any questions on this or anything else, give us a call too. Thanks, Travis Daggett, Cornerstone Properties, signing out.